and the daily growth, daily functioning of any organization. So we started learning about the levels of current assets in working capital and its impact. So let's understand working capital and current assets. For any working capital calculation, it is very important to have analysis of two things. One, current assets, and second is current liability. The current assets are those assets which are mandatory for our current payments or honoring our immediate liability. Whereas current liability is that liability, if we can minimize, it will generate more revenue. So we need to ensure that current assets are higher than the current liabilities and it will enhance my overall growth and working of capital. What is working capital? This we already discussed, but I repeat it again because last lecture there was live power off and many students were not present. So it's a difference between current assets and current liability. And when my current assets are more than my current liability, it will be called as a good financial health. It indicates that I have ability to pay the immediate short liabilities, that is current liabilities. So if I have more current assets, it's welcome situation. But even I have more than required current assets, it's not a welcome situation because excess current assets will lock my future investment. So current assets, how much I'm having and how much utilizing, it will decide how I'm managing my resources. If these current assets I'm having and I'm ensuring that they are properly managed, they are kept as per the levels they are required and they are managed as per the levels they are desired, then I will not in question and I'm very easily able to manage everything. But if they are short or they are excess, it always create a trouble. Now, what are the parts of current assets? Normally, current assets are defined those assets which are easily convertible into cash or near cash. Their value is always changing and they never been hold more than 12 months. So their nature is that they are always changing in one financial year. Secondly, they are always deal with current liabilities, assets, and their holdings. So current assets are those assets which are short-term resources easily convertible into cash. The components of current assets are cash, bank, account receivable, inventory, that is finished goods or raw material, or work in progress, and prepaid expenses. Here, debtors also part of current assets, but we covered under equivalence. Why we need to focus on current assets? Because current asset is our liability to pay off the immediate expenses. It is an part of operational strategy that how the funds are arranged and how the funds are paid for short-term obligations or functioning of organization. So in short, I'm trying to study that if I'm functioning a required capital, then in such case, the said capital, how I'm going to utilize, how I'm going to organize, that will make impact to my organization. Because if this capital is internally managed, efficiently available, then I need not worry about the operations. So if these assets are efficiently covered, then I can easily collaborate and go and focus on development rather than source of finance and how to meet the obligations of finance. So indirectly, I'm trying to control and adjust flow of operations in more productive way. If my operational efficiency about current assets and current liability is effective. Now let's talk about components of current assets in working capital. First, we'll talk about cash and cash equivalents. The most liquid assets available for immediate operational needs include bank deposit, short-term investments, and other investments which are convertible within 90 days. So bank, plastic money, near money, FD, short-term investment, these are called cash and cash equivalent. Inventory is a material which we are holding. This we can sell in short term and earn the profits. It contains raw material, work in progress, and finished goods, which can be easily converted into cash. Then we have account receivable. This can be account receivable note or debtors who has taken the service or goods on credit basis from us. And last one is prepaid expenses. These are the advance payments for future service we have made. So whatever the advance payments we have made for future service, they are also recognized as prepaid and these are part of current assets. Now let's talk about impact of all these current assets on liquidity. Each current asset is responsible for financing my short-term needs, for financing my operational funds requirement. So if I have convertible cash and near cash amounts, it will easily control my cash management. So if any urgent needs or if any urgency, I can immediately arrange the funds. Similarly, if my cash management or convertible securities management is excellent, in that case, I can focus on productivity and growth. If I keep more money with me, unnecessary, I lack the opportunity of returns. So in cash management and near cash management, if I efficiently manage cash flow and compare with the fund flow and returns, I can efficiently talk about how more revenue can be generated. In case of inventory, these are the optimum store of creating scrap and wastage. There are certain techniques like just in time, Kaizen, Six Sigma, or economic order quantity. So what I can do, first I need to invest the amount which is required in excess or in short. If the amount is invested, then the inventory will result in loss because if it is more than required, the stock will be wastage. It will convert into scrap because its validity expired. And if it is short, then at the time of production, my production may halt because raw material is not available or inventory is not available. So I have to take care that understocking and overstocking is avoided. Secondly, if I plan my inventory, I can find out the source of inventory more effectively. And strategically, the price negotiation, the quality negotiation, and the cost involved in storage will be reduced. Many times it is observed that if I have more than required inventory, then in such case, it results into scrap and frauds because people will enjoy the benefit of excess inventory. And in surplus situation, it might possible that they are misusing the available inventory because it is excess number or the optimization of output from available inventory will be less because in this case inventory available is very short and one cannot produce if the inventory is wasted. So wastage, overstocking, channelization is avoided if inventory is optimized. Then receivable management. Receivable management has two parts. One, debtors, and second, bill receivable. In both the cases, if my receivable management is excellent, the cycle of repayment by debtors is very short and they are honoring their debts. There is less collection charges and less efforts are required for collecting the funds. Then in such case, my management will be excellent and I don't require a great efforts to manage my funds. When I'm paying my creditors and when I'm collecting from debtors, the gap is in my favorable situation. That is, I'm receiving more, paying less. Then in such case, my credit policy will be appreciated positively and my funds available for internal usage will be from management of receivables. So how significantly I draft my debtors policy, I formulate the system of debt collection, I enhance the credit appreciation and analysis of debtors so that possible loss is avoided. I have better efficiency about receivables and indirectly this will help for cash management and resulting into more better source for financing my liquidity. And when I have better source for financing my liquidity, this will help me for significant working capital management. The last part is strategic repayments. If I find the change in taxation policy, there will be change in rate applies, there will be change in the approach or the discounts, then I can take a call about prepayment. When I'm doing prepayment for discounts, for reducing the cost, for avoiding any tax burdens, then these kind of strategic prepayments are always helpful for businesses. So students, please read this slide. I'll wait for 2 minutes. So if you read the slide, you will understood there are different components and each component talks about four things. One, cash management. Second, discount or advance benefits. Third, receivable efficiency. And fourth, strategic planning and arrangements of internal source of finance. So let's move further. How we calculate and analyze current assets. The formula for current assets is current assets minus current liability will get working capital. For example, if I have 3 lakhs current assets and 2 lakhs current liability, then when I deduct current asset minus current liability, the value which I get is 1 lakh. So, okay, PPT is not seen. Just a minute. So, the 3 lakhs is my position to pay immediately, and 2 lakhs is my obligation. That means the rupees 3 lakhs funds are available to me to pay the immediate requirement, whereas 2 lakh is the amount which are required to pay. So out of 3 lakh with me, I can pay 2 lakh immediately. So 1 lakh is available for operational benefit. So this is called working capital. Then what is working capital ratio? The ratio of current asset to current liability is called as current ratio, and it is recognized as ratio of working capital because here we compare how much current assets are available for financing current liability. So if current assets are 3 lakh divided by current liability 2 lakh, so it means 3 divided by 2 is equal to 1.5. My current liability is possible. So I can calculate here current assets divided by current liability. So it is 3 lakh divided by 2 lakh is equal to 1.5. As per industry, the ideal range is between 1.2 to 20. So if the ratio is 1.5, it means company is doing well. But suppose if ratio is less than 1.2, the company is taking huge risk because it's not managing funds in appropriate way. Similarly, if the ratio is more than 2 lakhs, it means the value of current asset is more. So if I'm holding current asset more, then I'm losing the opportunity of investment. So what I need to take care, the ratio should not be more or less than 1.2 to 2.0. So let's move further. The working capital has a variety of types, but the net working capital we call is current assets minus cash minus current liability minus short-term debt is called net working capital. And why this is net working capital? Because this will give the exact part what I can generate from my operational efficiency. Technically, these concepts do not exist, but for theoretical part, we should know the meaning of net working capital. The difference between working capital and net working capital is we are reducing cash conversions. For example, cash and short-term debts we are reduced. This will give the non-monetary or non-cash obligations And indirectly, this is net funds which may require for operations, whereas the other type of working capital is operating working capital, the funds which only required for operational purpose are known as operational working capital. The funds which are used for admin or non-operational expenses or investments is operating capital. For example, if I pay penalty, if I make a provision for depreciation, it has nothing to do with working capital. So the margins or investments or benefit I received from operation is only operational working capital. Now, how the impact of industry and business size on working capital? When there is a manufacturing process, normally, if I compare with the service industry, the operation cycle, sorry, working capital cycle of manufacturing industry is more than service industry. Secondly, the levels of working capital or number of current assets in working capital are more when it is manufacturing industry. The tenure or the amounts are short in service industry compared to the manufacturing. Similarly, if I consider the wholesaler retailer, wholesaler has larger part and retailers or distributors has smaller part of inventory. So when the scale of operation is reduced, the level of inventories proportionately go declining because their operations are limited. So when my scale of operation is going down, my number of inventories are also get reduced. In short, when I shift from wholesaler to retailer to distributor and to the end shop, the requirement of working capital go down because inventory requirement is reduced. If I compare market risk and risk tolerance ability, then if I am have ability to take the risk and my market size is large, then I need to hold a large inventory. I need to hold lot of data. Then in such case, my working capital will increase. If I have very short market and only cash basis, then there is no debtors, there is no loss, no creditors, then my cycle will be short and level will be low. So based on my production, nature of production, number of operational cycle, distribution network, company size, market volatility, risk tolerance, and allocation strategies for current assets and current liabilities will make impact on my working capital. I'll wait 1 minute. Please read this slide. Okay. Anybody, any doubt? So let's move further. Let's find out how to manage current assets for optimal working capital. Now, when I say optimal working capital, it's a situation when I'm holding my current assets in proportion to my current liability, ensuring that I'm able to honor my schedule of repayment, but no excess funds are invested, creating wastage and more obligations, whereas no shortage is there, resulting into hold or blocks. So, in managing working capital, I need to ensure that I'm arranging the funds in proper sequence and I'm making sure that they are available as and when required. Now, what are strategies for optimal? The first is accelerate my collection. I to ensure the short collection period, the less cost of collection, and proper sequence or proper coordination to enable that whatever the credit sales or whatever the dues from debtors, they are recovered in time without having extra cost or burden. If I have a system of proper recovery, follow and calculation, then in such case, I will not have a constraint of lack of available resources and I can easily optimize my working capital. Similar to the debtors, if I have negotiated terms with supplier and I optimize the time by comparing the debtors repayment, then I don't require to arrange the funds for payment to suppliers. I will collect it from debtors, hold it for some period, and if I give it to creditors, it indirectly help me to get more benefits. And in such case, the burden of arranging funds is avoided. So if I have accelerated collections, channelized system of repayments, and negotiated terms with debtors and creditors in more profitable way towards organization, then my payment and collection to debtors and creditors is optimized. This optimization will help me to have more funds without any burden of borrowing or arrangements. Then we already discussed if inventory in excess, it will create misuse, frauds, errors, and scrap. Similarly, extra inventory will lock my funds which I can invest. If I have shortage of funds, it will lock in it will lack in confidence and the production schedule may get disturbed. If I have shortage of inventory, it will also lead towards goodwill because if the material is not available, production gets halted, it will pass the wrong message. So I need to optimize use of modern methods like ABC analysis, inventory management, or e- economic order quantity just in time, Six Sigma, to avoid errors, reduce the wastage, and maximize output from raw material, and make sure that the production is encashed in acceleration. And the last, I need to maintain the optimum cash balance, not extra, not short, so that the expenses are paid, but investments not reduced. So I'll wait again one more minute. Please read this slide. If any doubt, post in chat box. Anyone, any doubt? Okay, let's move further. The best way to optimize working capital is to track and analyze the liability and the credit positions. If I am following the optimal working capital, but I fail to forecast and control the flow, then the efforts will be invested. So what I need to follow and study the trend of my current assets and current liabilities. I need to analyze the structure of my working capital, its growth pattern, how the fluctuation is taking place, what is the impact of seasonal, and how the resources are arranged. So indirectly, I need to ensure how optimum way my funds are allocated and what are regular changes. So then I can apply the tools like 6P1. I can apply the tools like ratio analysis, fund flow management, and others so that my working capital is optimum and I'm benefited. Now, what is real world impact? If I have surplus inventory, it will make an impact that I have extra burden of management because I need to take care that it is not spoiled. Secondly, funds are locked and it will create an issue about space. Third, it is always risky because people will start misuse or it will create and what you can say that mm, more spoilage rather than normal, and it will also be risky to hold assets for current as inventory for longer period. So misuse, spoilage, operational efficiency, risk of buying, and most important, quality deterioration is and a question if I have excess inventory. So maximize the use of inventory tools and techniques and enhance the skills, and this will help me for better inventory management and indirectly for better management of current assets. The second thing is liquidity risk. If the equation of current assets and current liability is not properly managed, then I need to arrange funds for or my operations from external sources. When I need to arrange from external sources, it will always create a confusion and question why, how, when, and the rate of interest, the available opportunities will lead to confusion and loss to myself. So, in this case, I need to take care that my debtors and creditors are managed properly. I am able to arrange the funds from my internal operations for working capital, and minimum liquidity risk is followed because if I take a larger risk, it may either lose the confidence in markets or I cannot better have negotiations with debtors for immediate payments, and my creditors will be in pressure and they might be give up the discounts and other benefits. If I have poor management of current assets, it will create a chaos in inventory, receivables, payment schedules, and borrowings, and ultimately, excessive application of internal force will lead to lack of growth opportunities, and I need to arrange the funds for strategic decisions. Now, on a screen, you are seeing two models. One is the manufacturing and other is inventory. Sorry, other is manufacturing and one is the retail business. In case of retail business, if things are sorted properly, they are taken care optimum level, you can see the customers will like it. He will buy the goods, he will happy to see the goods and the output is there. In case of production in manufacturing sector, here the things are in process. That one operation complete, other follow, and it is in synchronization, and the final product is displayed. If I have proper chain and system, then in such case, my manufacturing will be more important, and the production is created in quality. So, in conclusion, we can say working capital is again a strategic decision. It requires continuous monitoring. If I want to be successful, only borrowings will not work. I need to ensure that internal fund arrangements are more proper. If they are properly analyzed and understood, then in such case, these funds are always creating the profitability scenario. So I need to regulate my available internal current assets and current liabilities in such a way that they have optimum values, they are not short, not excess, and they will help me for my growth and strategic decisions. So first, I need to understand the characteristics of my organization, the levels of business cycles, and risk associated with my business. It is a production industry, it's a service industry, it's a labor intensive, or it's a capital intensive. What is nature of my product? And then I will take a call about how much working capital I should have and how I should arrange the funds. Based on these parameters, I have to focus and understand working capital. If I have a balance of liquidity and honoring the trade, then I am managing my working capital more efficiently and it will help for my growth and reduce the efforts of monitoring. So indirectly, working capital is an essential part and very important for running my company. How I strategically maximize operational efficiency, reduce the risk, and focus on more liquidity, ensuring optimum cash management and continuous control over the receivables and inventory will always help for my growth and better operational efficiency, leading to wealth maximization of organization and investors. So this is about inventory management and its introduction. So for any doubt, so let's talk about next part. So we talk about what is working capital, its strategic importance, and why we should control it, why we need to monitor it, Let's talk about working capital financing by bank. Banks normally finance working capital by short-term credits like overdraft, cash credit, and other things. Bank is one of the important source for financing working capital because it will enable more potential achievements and benefit as they are less risky and easily available. So let's revise working capital. Working capital is the money which are required for my daily operation needs. It is an health indicator about my production cycle and my future needs. So working capital is a snapshot which gives an idea about monitoring, control, and regulation of my current assets and my short-term obligations of payments. If the situation is positive, they are properly controlled and gives a positive health indicator about organization. These organizations are more preferred and healthier for reinvestment and development. Since working capital always talks about honoring the short-term obligations, payments toward the liquidity, they always be essential for analyzing the payments, for example, payment of inventory, suppliers, maintenance, and payrolls. So if I have better working capital, then my essential payments are honored easily. If they are honored easily, they're easily possible that they will create and trust and confidence in the minds of creators and help for better credit management and optimizing the funds for operations. If debtors, creditors, and internal factors are happy about payments, short-term obligations are made, then this will serve as growth indicators and the goodwill of the firm will increase. Now, most important, let's understand role of banks in working capital. The bank is ultimate source of funds which is used for managing the gap between outflow and inflow due to some specific incident, due to some shortage, or due to some activity. If the funds I need to arrange, then I approach the bank, and this the difference between outflow, that is expense, and income, I need to arrange temporary from banks, and this is called as arrangement of working capital. Banks is also provide advice regarding management of funds and to control and regulate the flow of unexpected activities, expenses, and decisions. I can also consult for operational momentum regarding key decisions about finance from a bank. So when I get a funds from bank, I get consultancy, adjustments for current needs, and operational momentum. Because when I arrange from the bank, I don't require external investors or arrangement about equity for managing my daily operations. Then how the banks support working capital needs. Bank will provide short-term loans, cash credit, or overdrafts, which is tailor-made solutions depend on nature of company, its production, its levels of operation, and they will help organization to sustain their cash flow. The short-term loans are those loans which are taken for 1 month, 2 months, 3 months, or 6 months. Normally, they will charge reducing rate of interest. As the amount increases, the interest rate also increases. Overdraft is over withdrawn than the available balance. This facility is normally given on the basis of hypothecation or mortgage that for a certain period you can withdraw excess considering your levels of operations. So, in short, how efficient I am, what is my last records, goodwill, bank balance based on this overdraft is given. Whereas in case of cash credit, the banks will honor my payments and they will intimate that okay, for 7 days we are honoring your payments up to certain limit. Beyond this limit or beyond this period, we are not going to honor. If these payments are honored, then it will help for short-term adjustment of funds. The difference between overdraft and cash credit is in overdraft, the amount and duration is fixed, but in cash credit, it is important for honoring the checks. So considerably, overdraft has more interest rate and more obligation, whereas cash credit is less obligation. For getting overdraft, I need to have more financial validity, but for cash credit, the reputation, turnover, and linkage with the organization is important. Then, when I'm talking about working capital needs from a bank, I can have a flexible terms of interest and repayment because ultimately banks are backbone of any industry. Considering my experience, considering my turnover, considering my cash flow and consumer base or market potential, they can assess my risk and on the basis of my credit worthiness or collateral, they can give me flexible financing. It can be flexible finance in terms of rate of interest, duration, repayment schedule, or anything. So I'm more benefited by borrowings if I require from banks. Similarly, the risk of fraud, the risk of excessive interest is reduced when I approach to the banks. Many times, bank will provide me consultancy as a complimentary if I borrow from them. So in short, borrowing from bank is always helpful for tailored solutions, flexible terms, and optimize risk. I'll wait for 1 minute. Please read this slide. If any doubt, let's move further. What are types of working capital finance offered by bank? The first is working capital loans. Now, overdraft and cash credit are a regular part of financing working capital. So we are looking now core part. The working capital loans are short-term operational finance with a fixed repayment schedule provided by banks. Like regular loans, these are loans, but they are derived in two terms. One, they are short-term, and second, the rate of interest is normally more since it is for short term. So, in terms of working capital loans, I borrow as a business and assure repayment after 3 months, 6 months, but less than a year. Working capital loans are way to support the funds for operations where I'm borrowing money for financing my working activities. Second, I can have invoice financing. So what I'll do, whatever the sales I had generated, trade sales, I always issue the goods on the basis of invoice. So I will go to the bank, show them the invoice I'm having. Based on invoice, I can request them that please arrange the funds. I have this much sales, but the money is scheduled to be received after some days. And based on invoice, the bank can arrange funds for short term. Now, many times, this invoice is a mortgage or they are discounted with the banks for lesser interest. The third way the bank normally finance is overdraft or cash credit. We already discussed this. The fourth is purchase order financing, where for raw materials or for creator payment, I approach the bank, I surrender the documents of purchase, and like working capital loans, I'll make a schedule of repayment and I will ask bank to honor the creator payments or supplier payments on behalf of the organization and they are being compensated. For working capital, I'm paying interest later, but for invoice financing or purchase order financing, if I require 100 rupees, banks will provide me 90 rupees. So while giving finance in case of invoice or purchase order, the banks are paying me in discount and recover me money at par. So these are certain common products, how the working capital is financed by banks. I'll wait for 1 minute. Please read the slide. Any doubt? So this is all we discuss. We talk about inventory management, we talk about current assets management, we talk about importance of working capital and how to manage. We started with how the banks finance, what a source, and why we should take finance from banks. Next lecture we'll discuss about additional options, real world examples, growth opportunities, and the risk and benefit of working capital finance from banks. Then we'll talk about strategic decision and its impact, and we'll further discuss other topics. So, if any doubt, please post in chat box. I'll wait for 1 minute. Otherwise, we'll call this meeting off and you can go for next session. Okay, no doubt. Please make sure today you are submitting your OJT and fill copies in a college. If you are not submitting today, then at least make sure that you will complete communication via email to your OJT guide. For all finance students of Sriram sir and Surat sir, you need to submit OJT reports today. I already signed everybody's report. Please submit handouts, OJT reports, printouts, and CD and student diary. Thank you.